Welcome to happy hour. I think I'm the only one who is actually having a drink during happy hour. So I guess cheers to me. Anybody else having a glass? I see Sandy has a glass. Ed, I have no idea what's in yours. You guys are drinking way too healthy. Wesley, that's Bai with vodka, right? Let's see. Oh my God, we have the famous Dave Ramsey again. And there's Wah. Wah, what are you drinking? Oh, you're on mute. I'm sorry. Looks good. God, if I was wearing my glasses, I could probably see Jaime. Oh my God. That's a blast from the past. Eric Carosa. What's up, man? How you doing? I got a friend on here who's probably the oldest friend out there. God, what, like 1985? Woo, looking good, man. And we have a special appearance by my father who wanted to hear what was going on. Dad, you can wave. There you go. Nobody is allowed to ask him questions. I was a perfect child growing up. We're going to wait just a minute or two. I'm not going to go long today, probably just an hour, but there is a topic I really want to hit right off the bat that is not really related to funds, but is absolutely related to all the LOIs and PSAs that we seem to be working on. Good for everybody out there. I don't know if it's in the water or in the air, but there have been an enormous amount of LOIs and PSAs accepted in the last 3 weeks, at least from our clients and new clients. And these are all over the country, not just Texas. So it's nice to see that parts of the country are doing well. And my father's on, so I'm not going to make any political comments. I'm not going to make any, well, I may make a little bit of a comment, but it won't be one side or the other. We have Alan Stewart on, representing Texas A&M. Did the Aggies win this weekend? They didn't play? I read lips. I don't think the Aggies played. So you guys see who won, right? 56-3. Now, granted, we played a high school football team, but still, it's all about the W. UTEP, go whatever you are, minors. I don't know what UTEP is. Jeff, how many people do we have on? We got about 54 people. Okay, so I'm going to attempt once again to share my screen. For everybody that's on, you're going to get a copy of, I prepared an outline, kind of what I read off of, because if I follow the screen, I'll just go off on a tangent and Jeff will have to shut me up. So I have an outline that goes into more detail from part 1 2 weeks ago and then today. And I was going to go over and start with what we went over last week briefly, but I don't think that's necessary because I want to spend a little time. I'm going to share my screen, so I'm not going to see any of you guys. Jeff, yell at me if for some reason it doesn't work. Let's see. Rob, can you see it?
Yeah, we can see it.
Good?
Yes.
Okay.
Yes.
So this is the beginning of the slide. So this is from last week. So we went over the types of funds, whether it's a single purpose fund, one asset, one capital raise, blind fund, you want to have targeted parameters, multiple assets, potentially, whether you want 100% of your capital up front, 10, 20, 50, that's in the outline. And then open period, how long you want to continue raising capital in that fund. Jeff, you'll let people in as they come on, right? Good. And then we talked about sponsors. And all the different things you want to look for in a sponsor. And I know Waz and Jaime are doing a great job. They're actually very busy right now. It's exciting to see what they're doing, and they're checking out sponsors, picking some really good partners on their deals. But you look for personality first, in our opinion, experience, do a background check if you're not familiar with the people. If you're going to be doing a potential capital raise, make sure you are bringing in partners for the right reason and not just to bring in capital and provide them a percent of something, GP interest or manager interest, and then not have managerial duties, because that's illegal under the SEC. Never hurts, though I know none of you will probably ask, but never hurts to see your pre-partner or sponsor's PFS, personal financial statement. Most of them, if they want to be a sponsor, shouldn't have any problem giving that to you, because they're going to have to give it to the bank the moment the bank starts its due diligence process. We talked about a few more things, but I wanted to kind of get that out of the way. So today is part 2, final part. I'm going to try to wrap this up in an hour. We'll see how that works. It'll be the speed round. Please ask questions because there may be some interesting questions here. No question's a dumb question. And if it is a dumb question, I just won't read it. So it won't be a dumb question. I'm going to start off with something that has nothing to do with funds per se. It's something that we have been dealing with in the last week from clients and then some of our own ventures that we're starting to do. So we're going to talk about not the political aspect, but social unrest provisions, force majeure. I know you guys weren't really expecting, I posted it on Facebook earlier today that I wanted to talk about it. So we've had several clients and we've actually put a couple contracts together on some ventures that are unrelated to multifamily, but have the same effect. So potentially we already have social unrest, the definition of social unrest in certain large cities throughout the US. We're fortunate here in Texas, we have had very minimal and nothing to the effect that it is actually stopping anybody from doing their regular business. But in certain cities there have been. There is a possibility, albeit very small, that something could happen before, during, and or after the election. And so I'm not making predictions and I'm hoping everything is just fine, but as a lawyer and as a former corporate bankruptcy lawyer where you expect the worst but hope for the best, I anticipate the worst and I'm hoping for the best. So we have started putting it in our own deals. We've put it in 4 of our clients' deals. So everybody, well, I don't know if everybody knows, but most people know what a force majeure clause is. It's basically a clause that says if there's an act of God, civil unrest, riot, blah, 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 you know, basically either the terms of the contract can be extended or that you can terminate the contract. So I wanted to go over a few questions. I'm not going to give you guys the provision online. I have a sample provision that is very expansive that I will send out, Roxy will send out as part of the outline tomorrow morning when we have this recording finished. But I would highly, highly, highly recommend if you're going to use a force majeure provision, you speak with the attorney that's representing you. Hopefully that's us, but even if it's not us, you speak with your lawyer because they can be drafted so many different ways and they can actually turn out to backfire and harm you versus helping you if one of those events happens. So I was going to go real quick, just some questions that you look for and some language that you typically look for. So this could be whether you're a buyer, a seller, whether you're doing an oil and gas agreement, any type of agreement where there are services provided by one to the other in exchange for payment and it's ongoing, or at least it will last through the election period or a couple of weeks after. This is just CYA. Doesn't cost you any more to add it in a contract. And so I'm hoping that both buyers and sellers understand what this provision and the benefits of this provision is so that it's acceptable to both. But typically what you're going to look at is does the contract specifically reference any of the delays caused by disease or outbreak of disease, epidemic, pandemic, social unrest, civil obedience, governmental restriction of normal operations. Now, a lot of you guys are just going to sit there and say, well, wait a minute, we're still in the COVID pandemic. So first it was an epidemic, then it was a pandemic, then there was some social unrest. There's been a little bit of civil disobedience and the government restrictions of normal operations has been on and off since March. So arguably that is triggered by, the force majeure provision in your contract has been triggered. But the reality is courts have come back very recently and said that unless it was specific, that's too broad. And so that those force majeure provisions could not be enacted. So that's kind of an issue. That's why Cindy, Greg, and I back in mid-March, we were pushing, we used to call it COVIDisms. Don't be a COVIDiot. That actually came, I think, from Rob. But we created COVID provisions to start putting in LOIs and PSAs that basically protected the buyers and the sellers from due dates that were coming up, and all of a sudden they couldn't complete the due diligence because there was a shelter-in order, or of tenants might have had COVID or just been quarantined. So it came out of that, and now COVID is, I don't know if it's under control, but it's less scary today. However, they could ramp it back up during flu season. So we are still putting the COVID provisions in, and quite honestly, you can create a force majeure provision that includes COVID. I like to keep them separate because of this, where they're looking for specificity. So the second part was, does the contract instead rely on a more general or catch-all provision? So that's what we just discussed. I would try not to be too general, because the courts are construing these very specific. So too general, the courts are just going to say that's vague and it's not covered. And a lot of the agreements that the courts have looked at is the foreseeability. So that's why we're trying to jump ahead, and some of the clients have jumped ahead, foreseeing potential civil disobedience on the results of the election. Both sides, 3 sides, it doesn't really matter. It's just enough to disrupt normal business. And if it disrupts normal business, you don't want to be in a position where, you know, you only have 5 days left on due diligence and you have no option. So the way these provisions are built in, and they're more specific than what I'm going through, because I'm going to cover some other topics today. And this was just an last minute add-on, but you either toll, which means you have a standstill in time from when that force majeure is enacted until it's over. So all of your critical dates essentially would stop on today's date. And let's say the force majeure event lasted 21 days. At the end of the force majeure event, the time frame just starts from right there. So you're just stopping a point in time and you're picking it back up when it's over. That's one option. And then other force majeure provisions that we've drafted in is, if it lasts more than 30 or 45 days, the purchaser has the option to terminate the contract. And here's the kicker: we're pushing for a full refund of earnest money. And the reason we're pretty adamant about it, and why I'm adamant about it, is because it's absolutely no fault of the purchaser, and the purchaser has the ability and had all the intent of going through with the deal, but the deal can't be out there forever. So whether it's 30 days, 45 days, 60 days, 90 days, it's a reasonable period. Obviously, it's got to be agreed upon by both parties. So that's something I just kind of wanted you guys, and Cindy and I and Greg and I wanted you guys to be aware of. So we're getting some questions. We're going to strongly push for a very tight force majeure provision in LOIs and PSAs, because if you think about where we are right now, it's September 15th. You have to about November 3rd. So you're looking at about 48 days. So many of the contracts and LOIs people are working on right now will not get through the due diligence period before the election. And again, the assumption is everything is just fine. But we want to CYA, we want to protect for things that we don't know of. That's typically why you go to a lawyer anyway. We bill lots of extra fees to make sure that you're protected in that 1 out of 1,000 chance. We're like basically legal insurance. So I'm going to go to the next slide. Where I left off last week was state of incorporation. Cindy, if we have any questions, just let me know.
Yeah, right now I think we're good. Nothing pertaining to that. So
and let me just stop for just 1 second. And I do this on every one of them. Anybody that wants to put out their contact information and a sentence or two about who they are, what they do, you're welcome to. Normally we would be having drinks and Cindy would be paying for everybody. And you know, we'd be schmoozing for 15, 20 minutes before and then 30 minutes after. So your schmooze time is on the chat box. Please don't list specific deals on there. If you have opportunities, hey, I have opportunities, but if you're going to do that, you better make sure it's a 506C. If you're going to say something like that, I'm more interested in, hey, who are you? Where do you live? And you know, what kind of assets you invest in, something like that. So the discussion basically is state of incorporation. Everybody's got an opinion on state of incorporation. It's if you ask 3 different lawyers what the best state is to incorporate, you're going to get 3 different answers. You may get more, because I will say Texas if you're in Texas, and then I might defer to another state if you're not from Texas, even though we're representing you. But the most common states that we hear about, or that we're asked about outside of the state where that asset resides. So I'm gonna emphasize your best bet initially is to incorporate in the state where the asset resides. I don't know anybody buying assets in Wyoming. I don't know anybody buying assets in Delaware. So I'm just not going to tell you what not to do. I'm just going to tell you what seems to make sense with respect to those states. But first and foremost, your state of incorporation is best in the state where the asset resides. With that said, there are three states that certain groups really push, and I don't know if they push them so much because of fees. They do create some fees. They do have some small benefits, not as much as people would expect for the type of assets that we're all buying, real estate related assets, income producing assets. We're not really in litigious business, and yeah, we all get sued by occasional contractor or a slip and fall from a tenant, but none of these states are going to protect the manager or the property manager from being sued. So again, I'm going to go over these very quickly. The first is Wyoming. Most companies incorporate in Wyoming because the administrative costs are generally lower than in Delaware or Nevada. That's not saying a whole lot, but I'm comparing Wyoming, Delaware, and Nevada as the three states where people sometimes incorporate based on advice, and sometimes we have to unwind them. I'm going to get into some other issues, but unlike many states, Wyoming does not require licensing or filing fees to be paid to complete the process of incorporation. The only fee Wyoming charges is an annual fee to maintain the corporation, which is $52. So you guys are saying, wow, that's great. It's only $52 a year for Wyoming. Wyoming also has personal asset protection laws in place to protect business owners, company officers, blah, blah, blah. The state also takes data protection laws very seriously, which is not really doesn't have any impact on anybody here. Wyoming doesn't require business owners to be U.S. citizens. That can be helpful if you're taking out of U.S. investors. But quite honestly, if you're taking out of U.S. investors, incorporating Wyoming is the least of your concerns. So I'm not really sure what type of advice people are getting with respect to this. And then they exclude some countries like Cuba, Zimbabwe, Burma, and North Korea. So if any of you have investors from North Korea and they're trying to invest by paying uranium, probably not a good idea to have them as investors in any of these states. That is legal advice, and you got that one for.
Merrill, you're on mute.
I didn't mute me, someone else muted me. Thank you. I'm going to say this for all three states, Wyoming, Delaware, and Nevada, but we're finishing up with Wyoming. So just because it's $52 to file in Wyoming, let's say you buy an asset in Houston, Texas. So you're going to have to register both the LLC and the manager of the LLC, which is typically another LLC in the state of Texas as a foreign entity doing business. So that registration costs you $750 per entity. So now you're paying $1,500 to register as a foreign business, and you're still subjected to the Texas franchise tax. So now you have potentially a Wyoming filing that you have to prepare. You have to deal with the Texas state franchise tax, and you paid $1,500 in fees. So everybody knows, and I'm not just pro Texas, we just happen to be officing in Texas, but it's $308 and I believe 10 cents to file for an LLC in Texas. So it's $600 to file two LLCs versus $1,552 to file in Wyoming, and you've really done nothing by filing in Wyoming other than creating more expense, but you haven't saved anything. You haven't really protected yourself with the type of investments we're talking here. Now, most large companies, when I say large, like Fortune 1000 companies, they choose Delaware. They choose Delaware for completely different reasons than I would recommend any of our clients choosing Delaware. Caveat there, we talked about this last week. Cindy, Greg, and I, we have run into quite a few lenders council that are requiring some of the entities to be Delaware entities. And they're doing this for the reasons I'm about to go through. So it's certainly not to the benefit of anybody on the call to file in Delaware. The lenders believe it's to their benefit to file in Delaware because they're so pro lender and pro big business up in Delaware. So in Delaware, many corporations register because of the state's lucrative tax codes. They're very corporate friendly laws. Investment bankers often require publicly traded companies to incorporate in Delaware, comply with their security laws. Their security laws are very similar to the SEC. almost every Fortune 500 company is incorporated in Delaware. And again, it's largely, this is going to be interesting to most of you guys, it's largely because of their premium justice system. So in other words, they're filing in Delaware because the courts, when their lawsuits, are very favorable to them. But it's also very expensive to have a company in Delaware. Counsel for Delaware, lawyers in Delaware are typically running, we talked about this last time, 3 to 4 times the rate of what your Texas, Arizona, Florida lawyers are. To give you an idea, we do legal opinions all the time. They're required by the lender. I think Cindy said last time we charge a couple $1,000s for a detailed legal opinion. If you're required to file in Delaware, then you've got to get Delaware counsel to file a legal opinion. It is a form that is given by Fannie or Freddie or HUD. It is an actual form that you really fill in the blank. You literally, as the lawyer, fill in the blank. The reason that law firms charge more than just for a form is because there's liability attached to it on behalf of the law firm, because we're actually attesting that everything our client is saying and doing in this deal has been performed according to the law. So we actually have personal liability on it. With that said, whether you're Delaware, Hawaii, Alaska, doesn't really matter. The form is the same. So the Delaware attorneys are typically charging $12,000 to $18,000 for the exact same work. Again, I think we charge a couple $1,000s. That's pretty consistent with most firms in Texas, Florida, and Arizona. So that's just for one document. So again, when deciding where we're being given the choice of where to file, you need to think hard about, one, why is the person convincing you to file in Delaware and Wyoming? What are they making off the deal? And two, and Nevada as well. And two, really, what is it going to cost you? There are a lot of hidden costs. People think that they're protecting themselves and there's anonymity. Hopefully the guy is the client is not on the phone. It actually wasn't a client. It was somebody that was on a call. I think it was 3 or 4 weeks ago on a Zoom meeting with us. And he bet me that, I don't know if Cindy was on this call or not. You remember this? They were out of,
email chain though, yeah.
Yeah, they're out of Portland or something like that. He bet me, he said, I'm telling him, you shouldn't have filed in Wyoming. I filed in Wyoming because I went to this consulting group. They set everything up. I was shocked at the rates they charge. Doesn't matter. Filed in Wyoming. I said, why'd you file there? To protect myself so nobody can find out who I am. So I left it alone. And then after a while, those of you that know me know I just can't control myself sometimes. So I sent him an email and I said, I'll bet you I can find out. I bet you I can find something on the internet in like 2 minutes as to, who owns this company. Because I knew the name of his company, but I bet I could find out who the owner was. I think it took about 12 seconds on Google. It was on the first page. His name was on 3 different hits. It was like number 3 through 5. And so it wasn't me trying to be an asshole and say, ha, ha, ha. It was more of, you shouldn't be filing your future entities in that state because you think it's doing something, because it didn't do anything. And they spent a fortune setting up their entities there. So get good counsel, talk to lawyers before you do it, and find out why they want you to file in those areas. The filing fees in Delaware, it's $225 for corporations, $300 for LLCs. The other thing about Delaware, you have to have a registered agent in Delaware, and they charge you an annual fee. Sometimes it's not bad, sometimes it's pretty excessive. And any suit you have, in theory, could be brought in Delaware. You're going to have a choice of law provision that hopefully is where the asset's located. But technically, because you're a corporation in Delaware, you can be sued in Delaware. And so then you're going to have local counsel in Delaware that's going to be a fortune, and you're going to have your own counsel in whatever state you are that's going to be advising local counsel. So you're literally paying your lawyer's bills and then the Delaware counsel's bills, which are going to be 2 or 3 times your lawyer's bills. So it's not a good situation. The other state is Nevada. Not unlike Delaware, investment bankers many times require publicly traded companies to incorporate in Nevada to ensure compliance with security law requirements. Nevada security laws are very, very similar to the SEC. There's a one-time filing fee in Nevada. It is $725. It is the highest in the country to actually file in that state, to say you're incorporating in that state. Like I said, it was $750 to file as a foreign entity in Texas. but you still have to pay somewhere else to file, which I think in the example we're using Wyoming was $52. There is also an annual fee of $325. So guys, gals, it is not cheap to file in Nevada. And if someone is telling you that, they're lying to you. It's $1,050 first year and then $325. It's important to remember that small business owners must register as a foreign registrant. This was kind of what I was getting at, in their own state. So if you're doing business in Florida and you file in
Meryl, you went on mute again.
Any buttons here. Make sure Jeff's not hitting me on mute because I'm just talking too much. I'm not, look, no hands.
I'm not. All right, yeah, no, keep your hands up while you talk.
So, yeah. So, yeah, kidding. So it's important. What I was saying was Nevada is one of the most expensive states to file in. And again, just like Wyoming, I'm willing to bet that anybody on here can do a Google search and within 1 or 2 pages, find out at least one or more of the members in a Nevada corporation. Also keep in mind, to the extent that there's going to be litigation, a very quick discovery document will get me the names of every single person in any entity. And that's the same with one of the 350,000 lawyers that are in the United States. So don't be duped into trying to file somewhere because you think you're protected and you're incurring more expenses and potentially more tax filing. So again, this is the beginning of part 2. I just want people to be aware, you have choices. And again, the first choice from our perspective would be to file in the state where the asset is located. Second choice is, from my perspective as a former bankruptcy lawyer, I would pick Texas or Florida to the extent it makes sense. Both of them are very, very pro-debtor, meaning you're borrowing money from Fannie, Freddie, whomever, or a regular bank. They're very pro-debtor. So I would pick one of those 2 states, and I would have Wyoming, Nevada, and Delaware, my opinion, only if you have assets in Wyoming, Nevada, or Delaware, or you're trying to bring money in from they can't do North Korea, South Korea up into Wyoming. Being a little facetious there. Okay, I already went over foreign entity registration. So again, if you file outside of the state to which the asset's located, you are going to be required to register as a foreign entity. And then you'll have to pay whatever the franchise tax or potentially income tax is. And just as an example, when we had our single family business and we were doing business, we had 1,500 rentals in Indiana, we had 2,900 rentals in Missouri, and we had some in Kansas, and we had some in Texas. So I had to register, they were all Texas entities. I had to register each entity as a foreign entity in Kansas, Missouri, and Indiana. And then I had to pay state income taxes in Kansas, Missouri, Indiana. And I had state franchise taxes in Texas because our headquarters was in Texas. And we have very good CPAs, Savile and Associates, that helped us get through that. But again, you think you're going to avoid things, it's not going to turn out the way you want. So be very careful in making your selection. So let's get back to the fun stuff. Securities exemption. 99% of the people on this call, at least when I looked at it first, may understand the difference between 506B and C. It's very interesting. COVID has, I guess, a potential benefit of the effects of COVID, not COVID itself, but the effects of COVID. We have seen a lot more 506Cs in the last 2.5 months than we have probably in the last 2 years collectively. Cindy, you can nod your head if you agree with me.
No, I do.
Okay, good. So, and the reason we have is, one, there's a lot of dry powder out there. Everybody's been talking about dry powder, cash sitting on the sidelines. And 2, just like right here, people are doing Zoom calls now. So it's not just, oh, someone's got to meet up at a bar, or there's a meetup in Colorado, but I can't make it because it costs $5,000, or taking my kids to school or whatever. Now we're all connecting through Zoom and other types of video meetups. So people are establishing relationships and they're finding commonalities. And it's very interesting to see, from our perspective, the different partners that are now working together and investors from all of the states. We're doing more blue sky filings, I think, than we've ever done before. The blue sky filing is when you're taking an investor who's outside of your state. We're in Texas, and if I take an Oklahoma investor, We have to register with Oklahoma's Board of Securities. That's a blue sky filing. So we're seeing more of those than ever. And I think it's directly attributable to kind of what's going on and everybody being on these Zoom calls rather than in-person meetings. So the difference between 506B and 506C, those of you that know, these are exemptions under Reg D, that so you don't have to register your offering, but you still have to file it with the SEC. 506B, there's no public marketing allowed. Most of you people know that. So you can only send out information to sophisticated investors and accredited investors that you've had an ongoing relationship with. If you haven't had an ongoing relationship with them, don't send anything out to them. The advantage of 506B, the investors themselves tell you whether they're accredited or not. So they fill out the investor questionnaire, and it's up to them to determine whether they meet the accredited status. I can tell you that a lot of people out there think they're accredited investors, and they're not. I know this because I do all of my filings on our personal deals under the next exemption, which is 506C. 506C allows us to market to the world, and in the status that our country is in right now, as far as being able to move around and fly around and go to events, 506C seems to be pretty popular right now because we can market. You can market on social media. You can market. I've seen radio ad. I can't see. I've heard radio ads. I've seen TV ads for 506Cs lately. It's very interesting. The flip side to marketing anywhere and everywhere is, one, don't have too many partners when you're doing a 506C, or if you do have quite a few partners, only have one or two that are actually doing the marketing for the group, because you could run into the issue where people are marketing the same asset but not marketing the same terms or saying the same thing, and we have seen that, and that will get you into big trouble. So be very careful with that. And the other caveat requirement under 506C, because you're allowed to market to whoever you want, the SEC said, well, you're only allowed to take accredited investors. And its current definition means that an accredited investor is someone that has made $200,000 or more the last 2 years, expects to make the same this year, that is single. If they're married, it's $300,000 or more per year for the last 2 years and expects to do the same. Or they have a net worth of over $1 million, not counting their homestead. And a lot of you saw some posts where people got really excited because they revised the accredited investor information. And so Cindy is here to tell you, because I'm not always the bearer of bad news, it's going to affect none of you on this call. So if you thought you were going to get in under the new definition as it stands today, it's going to have zero effect on you. There was a lot of hype behind it, and many people just posted, hey, it's changed, more people can get in, and didn't actually read who actually can get in. So the reason this is a big deal, because 506C allows you to take accredited investors. You have a very large pool you could go after. Flip side, you have to verify that they're accredited, not them. So now you're in charge of looking at their financial statements, their tax returns, their personal financial statements, everything they've got that can prove their net worth. So that's a huge responsibility. If you're wrong, you can be fined by the SEC. You can also be prohibited from ever raising capital again. There are third parties that I personally utilize, Cindy utilizes, and a lot of our clients, like verifyinvestor.com. They're a small firm out of California. That's all they do. They do a very good job. I think it's like 50 or 60 bucks a pop. But back to the amended definition. So this is very exciting for absolutely nobody on this call. So if you hold a Series 7, Series 65, or a Series 82 license, then you will be deemed an accredited investor, and I think in about 42 days. There's a 60-day hold before the amendment goes into effect. So again, if you're a Series 7, Series 65, and a Series 82 or Series 82 license holder, you're deemed an accredited investor because you have knowledge of the sale of securities, because you represent people, and you're a broker for sale of securities. So that makes sense. And that's pretty much nobody on this call. One thing that actually might help some people on the call, to the extent you have an employee, in your fund that's part of your management team, or maybe even not part of management, but under management, that wants to invest and that has substantial knowledge as to the fund, that employee can qualify as an accredited investor. So, you know, I can envision it right now where someone goes out and hires 67 employees for a fund that's going to raise $3 million, and they get each one of the employees to put in 50 grand or whatever the number is. And then they turn around and terminate the employees. I know nobody on the call will do that, but I can envision someone asking that question. That's not going to fly with the SEC. The other thing they did is they slightly revised the definition of spouse to include significant other, partner, whatnot. I think it was already implied, and I don't think anybody was in states where same-sex marriage was legal. I don't think that has been an issue at all, but they just codified it by law. This goes into effect, I think, in 42 days. Cindy, do you have a question?
Yeah, I was just reading, which people may have missed this when you said it. What's the best way to check accredited status? Is it a letter from the investor's CPA confirming the investor is accredited? Okay.
That's a very good question. So the question, I'll read it, I'll repeat it. If you're doing a 506C, which is the best way to verify someone's accredited status? I take the path of least resistance. You can have an employee that does that. It'll take that employee about 3 or 4 hours to gather the information, assuming the investor is willing to give it to an employee of your fund, and then go through and verify and document that they met the accredited status. Or you would use a company like Verify Investor that Cindy and I and Jeff, our whole team, we always use them, and most of our 506C companies use them. It's really simple. They're sending potential investors send an email. They're given a list of documents that they need to submit, and boom, they're either accredited or not accredited. There's not a whole lot of discussion to it. They may have a few follow-up questions. We typically get a certificate from the law within about 3 or 4 hours. The easiest way to do, and I don't know why people are afraid to tell the investors this, we see it all the time. The easiest way, have your CPA or CPA firm simply notarize a letter that says they meet the requirements. If the CPA, if someone is a credit investor, they should be, if they're not, they should be having regular conversations once a quarter with their CPA. Hold on, am I muted?
No, you're not. Just on that point, someone just put out that CPAs are reluctant to do the accredited status.
Okay, yeah. So there's always someone that's going to say that, and I'm not going to disagree with that person. But in the last 3 funds we've done, I've seen more CPA letters than I've ever seen before. But one of the things we did do is we actually prepared the letter. So when you attach a copy of the letter, and the CPA literally has to fill in their name, sign, get it notarized, and check the box, it makes it much easier for the CPA. The CPA is going to know whether their client does or doesn't have a net worth of over $1 million, or their CPA is going to know by doing their taxes whether they met the income requirement. So if the CPA is that reluctant to do it, then they can go through Verify Investor. My recommendation is find a different CPA firm if your CPA won't do that for you. I know mine will. So I don't know why that would happen. But yes, there are some people that are, I guess a few CPAs are reluctant. And then it's funny, there are actually some fund managers, some syndicators, they're literally afraid to ask their investors for the financial information. So they got all excited. They want to do the 506C. They're marketing to everybody. And now you're just simply verifying the documentation to cover your rear end so you don't get sued, and they're afraid to do it. There is a 4th option. The 4th option is you can actually hire a mortgage broker. They'll charge you about $350 a file, $250 to $350 a file. And they're very familiar with this because they've got to do this all the time for lenders. And so they will do it, but I guess I'm cheap and I don't know why I would pay $350 or $250 when I can get it for $58 from Verify Investor. And if there's ever discrepancy, Verify Investor will go to and argue before the SEC that everything was right. So I almost get a guarantee, and it's only $58 a pop. So anyway, I hope that answers that question. Cindy, do you have another one?
No, I think And I think you had touched on this. Some people may have joined later. Just someone's asking if they can present their multifamily properties on this platform. And I don't think we want that.
Yeah, don't present the exact deal. You can simply, because I don't know whether you're doing a 506C or 506B, but I would simply list your name and contact information, and what you typically like to invest in, and the type of properties you look at. Don't be too specific, because I don't want to have to yell at anybody later. So yeah, I don't want anything specific on this site. Otherwise, we're just going to close the chat in the future. But you guys know, use your best judgment. And then obviously if you put it on there and it shouldn't be on there, you're not going to be back in the Zoom next time. I know I'm harsh. Okay, this one's fun. And by the way, in the outline, I've got an outline, I've got a split screen. In the outline, you're going to see a lot more information. I actually go through a chart, the difference between a Reg D, 506B, a Reg C, crowdfunding, and there are two other types of potential ways to raise capital that are exemptions that a lot of you aren't taught because you're part of different types of investor groups. But there are several different ways. So again, I highly recommend you guys download, when Roxy sends it to you, download the outline. I think it'll be really good. If you have questions, you're welcome to email any of us on it. But here's the fun part: manager fee and compensation. I'm going to caveat this. So we're going to talk about the different manager fees, how managers can make money on the front end, back end, and during the middle. And I'm going to tell you, there are certain investment clubs that have their own rules that allow for and don't allow for certain types of fees. So I am going to assume, for purposes of this discussion, that nobody's in an investor club that limits this or that has guidelines with this. I'm just going to tell you what we see in general. So the first one is an acquisition fee. Some clubs allow it, some clubs don't. Typically what we see on an acquisition fee is anywhere from I've seen as high as 5%, but typically it's 1 to 3% if we see an acquisition fee. An acquisition fee is essentially paying the manager, whoever that consists of, a fee for the due diligence they did, for putting everything together, for spending the 60 days or 90 days going through the diligence, the lender issues, the title issues, and getting it to close. I'm not saying they deserve it. I'm simply saying what the fee is for. As a syndicator myself, I prefer an acquisition fee. Nothing too hard, but I want something to compensate the time. Those of you guys and gals that look at assets, we all know very, very well that acquisition fee is not earned on that one asset. There are probably 10 assets we went through just to get the one asset, which is a significant amount of time. But again, it's going to depend on how your deal is structured, whether you think it's justifiable to take a fee up front. Then you have asset management fee. Okay, so asset management fee is a little bit different. This is not a property management fee. This is an asset management fee. You are the coach. I don't want to use the Cowboys as an example because there should have been no fee on that one last weekend. But you are the coach. And so you are in charge of everybody. So you should get a fee, or you may be entitled to a fee. That fee can be based on what we've seen, 3 different scenarios. One is just a flat fee based on revenue collected. If $200,000 in revenue is collected each month and you get a 2% asset management fee, you're going to get $4,000 a month as a fee, if that's in your PPM docs. Another is performance. So you can base the fee not based on revenue collected, but based on profit. Everybody gets a P&L at the end of the month. Typically, if you're using a property management company, you're going to get on the 15th day following the prior month. Regardless of when it comes, you can base your asset management fee on profit. And so if you're going to base it on profit versus revenue, you might want to increase that percent. Not telling you to, not telling you not to, but you're not going to get the same value because 3% on revenue versus 3% on profit, it's going to be a big difference because you're not taking out expenses on the revenue side. The other one, which is a favorite that we've used a couple times, is NAV. NAV means net asset value of the fund. So this comes in handy when you have multiple assets in a fund. You could do it for one asset, but it comes in handy when you have multiple assets for the fund. So essentially what you're doing is you're taking the cash on hand. We do it once a quarter. You take the cash on hand in the fund. and then you take the value of the asset, and that's typically going to be at a cap rate. You can determine the method of valuation, and you can use whatever method you want. It needs to be disclosed in your PPM, but once you choose that method, it's got to be that type of valuation, that methodology through the entire life of the fund. You can't decide, oh, I'm not going to do cap rate today because I'm not going to get a good cap on it. If you choose cap rate, you got to go all the way through. You use an independent third-party broker to do the cap rate. So basically, what you're going to take cash on hand plus the value of the asset based on, you know, either cap rate or sales. You're going to choose whatever that methodology is, and then you're going to back out whatever debt you have on the property. So if you have $1 in the bank, your asset's worth $4, and then you have $3 of a loan, so your net asset value is $2. And so if you get a 3% on your net asset value, you're going to get 3% on that $2. So that's 6 cents. That's another way to determine how you get the asset management fee. All three of these, though, are performance based or incentivized. You know, the more revenue collected, the better your fee is going to be. The more profitable you are, the better your fee is going to be. The higher value your property is, the better your fee is going to be. And if those of you that know how to determine cap rate, value is going to be based on performance. So every one of these incentivize the manager. So if I'm a passive, I want an asset management fee that is based on a percent and not a flat rate. Some get a flat fee. I don't like flat fees. I'm not a big fan of flat fees. Cindy, do you have a question?
No, we're good.
Cool. So, and we also see there's another way to make some money. If, again, this is if you think your investors will tolerate these expenses to the fund, but these fees up front. A refinance fee. Those of you that have gone through a refi or a supplemental loan know that it's not a walk in the park. Excuse me. There's a lot of due diligence. There's a lot of reporting. They typically can take 30 to 60 days, sometimes longer to go through. It's exhausting. At the same time, you're still managing the asset. So I wouldn't say it's common, meaning it's not in by any means a majority, but I would say 20-25% of the funds that I've seen have a refinance fee. It's typically pretty low. It's between 0.5% and 1%, and it's going to be of the financed amount. So it's certainly not a windfall for any manager. If you're refinancing out or you're doing a supplemental loan, typically there's going to be supplements. You know, when you're taking an extra $6 million out, you know, 1% of 6 million is 60 grand. You had your whole team working on it for quite a while you're working everything else. It's not a huge fee. The last one that we see, and this is with respect to just fees, is a disposition fee or an exit fee. It's really simple. We sold the asset. Because we sold the asset, we get a fee, almost like a broker's fee. But most likely you're still paying a broker's fee because you hired a broker. These are much less common in our type of multifamily structures, but we do see them occasionally. So as a passive investor, you want to look out for these type of fees. I'm not telling you guys that you shouldn't be investing in deals like this, but if you've got a management group that's getting an acquisition fee, an asset management fee, a refinance fee, and an exit fee, I would assume that the splits between them with respect to profit and proceeds are more in favor to the members than they are to the manager. Otherwise, this manager is getting a lot of money, or on the flip side, that deal is so profitable, the investors are still getting a huge return on their money, and they don't mind the asset manager making those fees. That's really not the case we see right now in multifamily. They're good deals, but I don't see deals where investors are getting 30 to 40% annually on deals. So again, just keep in mind the fee and compensation structure for manager. And again, we go into detail about this online on our outline. Okay, capitals. Yeah.
Just a quick one. This came earlier and just may need clarification for some people on the call. What's the difference between a passive investor and an active investor?
Okay. So I was going to make a funny, but I'm not going to make a funny. So an active investor would be someone who is a part of the manager team. They're actually doing managerial duties. They're typically going to be personally guaranteeing through a bad boy guarantee on the note, or their financial statements are going to be used to get the debt on the property. A passive, it's real simple. Cindy, I'm giving you $100,000. Don't talk to me. I don't want to hear from you until I get a check. That's passive. Now, don't be confused. This is where I'm going to be kind of a smartass. There are a lot of passive investors that are very vocal. So there's a difference between a vocal passive and a passive. A vocal investor is someone that wants to tell you what to do, wants to always ask how to run your business. But the reality is they're still a passive investor and they don't have any managerial duties. Passive investors are basically investors who are not syndicators or sponsors. That should say, do you have anything to add to that?
No, I was just seeing if there were some follow-up questions.
Okay. So I'm going to go through, you can read through, I'm going to go through this fairly quickly. So capital stack, these are just simply the thing that you need to learn. You need to be knowledgeable when doing a fund. And most of you already know kind of your capital stack, but a capital stack is, I've got an asset, it costs $100. How am I going to pay that $100? So when you hear capital stack or debt stack, that typically references all the money that is being used to pay for that asset. So your capital stack could be $100,000 in capital and $900,000 in debt, and you have $1 million capital stack. Okay. Why do people, I've got little bullet points here with respect to kind of what you should or shouldn't be looking at, and they're in more detail on the outline. But as you guys know, I like to go off on tangents sometimes. So, you know, when looking at a deal, it's important to look at your capital versus your debt. Everybody wants to be careful right now because of potential uncertainties with the economy, though I think I'm hoping we're more at the worst of what we've seen, and it's going to be the same or get better. But debt right now is basically being given away. We're seeing numbers in the 2.6, 2.7. Cindy, have you seen anything lower than that?
No.
So yeah, 2.6, 2.7. So basically you're borrowing money from the bank at 2.6. If you kept your money in the bank, you'd lose 2% on it because of inflation, which I think is going to go up. So I mean, basically they're giving money away right now. So it's a balancing act, and it's going to depend on how strong your asset is as to what your mix is going to be, what the optimal mix is between your capital and your debt. You know, keep in mind, the most expensive part of your capital stack are your investors. If there are any passives on here, I'm not ragging on passives because I'm a passive in some deals too, but we are the most expensive piece of the capital stack. We're going to get an IRR of whatever, 18, 19, 20%, hopefully higher on an annual basis. Or we're going to get cash on cash of, 8 to 15%. I don't know of anybody listening here who's got a loan at 8 to 15%. I don't know anybody who's got a loan at 20%. So these loans are coming in at 2.5%, 3%, no personal guarantees. So the lender really is your friend until you don't make your payment, which is kind of that way with anybody else. But try to when talking to your brokers, and there may be a few brokers on here, have them go and understand your capital stack. And it's interesting. So a lot of people don't do this. There are a few of our clients that do this. They figure, okay, the average return for the investor is going to be about 13%. Let's say it's 13%, and 20% of that capital, they have to pay back 13%. And the other 80%, which is a loan, I'm using 80 as a number, is 2.7%. So their average on that capital stack, and I just made these numbers up, are probably going to be somewhere like 3.7, 3.8, maybe 3.9%. So they're buying this asset for 3.9%. It's costing them 3.9% a year to buy the asset. That's unbelievable. It really is unbelievable. Now, you guys all know this. The higher percent you go on debt, the scarier it gets, because we are in a market where sometimes there are moratoriums, sometimes there aren't. I was just reading from some friends in our mastermind where the judges in Dallas are throwing out evictions that, technically are filed properly, but under the new moratorium, they're arguing it's not. And then our own experience up in Amarillo, we had no problem with the judges allowing for the evictions. So it's going to depend on market place as to the conditions, but I would be very cognizant with the percent of debt you're putting on your property. The 5 types of debt that you're going to see are agency debt, which are your Fannie Freddie backed loans, CMBS, conventional are going to be your local banks or your Wells Fargo type banks. Most of those are going to have personal guarantees on them. Private money may or may not have a personal guarantee, and I'm kind of going in order of cheapest from percent wise to most expensive. And then my favorite is hard money. It's only my favorite because I used to have a hard money lending company with a partner, and you guys are gonna laugh. So we used to charge, we get upset when we could only charge 14% and 4 points. Class. This gets to be fun. I love these type of deals. I try to get involved with clients that are doing these deals. I try to, when I say get involved, I try to do work on those particular deals where you're creating either a second tier of debt that's been approved by the investor. Preference, there's no guarantee, they get paid before anybody else. And so if that fund only makes X percent, they get paid first. The flip side is when the fund sells, they just get their capital back. They don't get the upside. So they get the protection on the cash flow, then they get their capital back. But that's a nice way to create a gap between, you know, your 13 to 20% you're paying an investor and your 3% you're paying a lender. You create a class that's going to get 7 or 8% in the middle. So you're not having to raise more capital and pay out that 13, 14%. Cindy?
We're good. Yep.
Cool. Waterfalls. I have a whole 1 hour, I think 1 hour and 15-minute podcast or Zoom on waterfalls. It's on our Kaliser Law. It's called Kaliser YouTube channel. So you can see everything that we talked about waterfalls, but it's kind of like what I just explained a minute ago, where you create separate classes. Waterfall provisions, bottom line, they can be as simple as the manager gets 20% and the members get 80%. And they can be as complicated as, okay, so the members have a 6% preference. And then once they get the 6, the manager and the members, they share 50-50 until the member has 13%. Anything over 13% goes to a 70-30, 70 to the manager, 30 to the investor. They work. You can make it as complicated or as easy and as simplified as you want. My recommendation is anytime you're taking new investors, use the KISS method. Keep it simple, stupid. There's nobody that, if someone has to actually write down and try to figure out how they're going to get their return after reading your PPM, you failed. Okay, so they're done. They're going on to the next PPM because they're getting 10 or 15 of these a week. So be careful. I would not suggest being too cute on them. You can be cute, or I don't know if cute's the right word, but you can get fancy and you can get very intricate. And the way they're structured, it actually incentivizes the manager to perform better, but they're so complicated for the members to calculate. Not that the members are stupid, but they're not getting the full numbers in trying to do their calculation. They're just going to go to something easier to invest in. But if you have a group of loyal investors and you're on your 3rd or 4th deal and you think there's a home run deal, you know, you can try doing the entertaining waterfall. I would highly recommend you talk to a syndication lawyer before you structure that. If it were me and I had a really unique opportunity and I wanted to do a waterfall that was different than normal, I'd actually just poll my investors. I would send a poll out to them through one of the local poll apps and just tell them, hey, this is what we're thinking. And A, B, C, or D, which one do you guys like? And that's the best way to do it, because then you haven't created a fund and filed it and now have to go back and amend it, or just run the risk of losing your investors. And again, it can be based either a fixed return on investment or a performance-based. As a manager, you're always going to get more investors when it's performance-based versus fixed. Fixed in investors' mind means they're not going to work that hard because they're getting a salary essentially every single quarter. Performance, if they suck, they get nothing. It's that simple. It's really not that complicated. Let's see what else I have. I'm trying to get you guys out of here at 7. Look at that. Exit strategy. Huh? Did you say whoa? So yeah, exit strategy. I didn't really go into detail about exit strategy. I'm putting everybody back on line so I can say hello to people. I didn't go into huge detail about exit strategy because the point of the exit strategy is simply know your exit strategies before you even buy into the fund. Before you buy the asset as a syndicator, have 2 or 3 different exit strategies. Do not have one exit strategy. Your investors are going to ask you, what are your exit strategies? So I highly, highly, highly recommend know your exit strategies. So I don't think there were any more questions, Cindy, right?
There are not.
So I was going to see, so I was going to just call out a few people. I like to do that. So we're working with Nicole, who's on there. Let me see if I can unmute Nicole, have her say hello to everybody. Let's see.
Hi.
Hey, Nicole, say hi. So Nicole is from the North Pole and she's visiting us. And actually she's from Minnesota. I've already asked her if she knew any of my dad's relatives. Thank God she didn't, or she wouldn't have engaged us. But we're doing some consulting work and we're representing her on some deals. And it's interesting. We have a storage facility that we're invested in Amarillo, and Nicole and her father have 5 storage facilities up in it's the Rochester area, right?
Yeah, southern Minnesota.
Southern Minnesota. And she drinks Pepsi because they don't have Coke in Minnesota, but they call it soda, so it doesn't even matter. But anyway, so I've been looking at the way they model their storage, and it has absolutely fascinated me. I know storage has always been a good deal, but they actually go and create their storage facilities. In most cases, they're taking a box or they're just building it, and they build it out. And she also self-manages. They've got, again, 5 storage facilities. She's working on several others. Just started joining on the groups. And like I said, we're doing consulting helping out on her latest venture. But I tried to call her out last time and she hung up. And I said, nobody hangs up on Meryl, because I see 6 of you just did. She hung up on me. And so anyway, shout out. Nicole, did you put your information out there?
Yeah, I did.
Somebody wants to go visit Minneapolis right now. I'm sure it's great up there, right? She's nowhere near the stuff in Minneapolis. So I see Ed Faulkner. I can't keep up with Ed. Ed, are you still doing your ice baths? No. I see Dave Ramsey. I'm not going to put him on because I won't be able to get him off, but we have the Dave Ramsey. So, if you're doing your cost segregation analysis, and by the way, guys, if you're doing cost segregation analysis, you got to start it now. You absolutely have to start it now. I mean, technically you could wait till the end of the year and really piss Dave Ramsey off, but start it now. Dave's got his information out there. Their company is phenomenal. We use them. So we have Dave Ramsey out there. None of these guys pay to be on here. I just want to make it clear. The only reason I'm calling them out is because we either use them or they're our clients. Jeff King, Ramey King Insurance, great insurance guy. He's out there. I know Jeff. I'm not even looking at the chat, but I know Jeff put his information out there. And then, well, you guys will love this. So those of you that are in DFW area, we have Juan Jaime. So they are optometrists. Did I say it right? Now they're not even listening. So you see Wah is not even listening. Yes. Yeah. So Wah, I'm going to let her talk for a second. So I have Wah, and Jaime's probably cooking dinner. I thought I asked you to unmute. Wah, see if you can unmute. It may not let me.
Hi.
Hey, there you are. So Wah and her husband, I love to embarrass Jaime, but he's not here.
He's coming. He's coming. Hurry.
So you guys because you guys know I'm a smart ass, I like to tell jokes. So Jaime is the most conservative person I think I've ever met. He dresses special, but he's a very conservative. There's Jaime. Jaime is the man. So besides the color of shirts he wears, he's a very conservative person. Yes, he's always got colors. So I went in for an eye checkup because I hit 40 for the 11th time and decided that my eyes don't work the way they should be working. And you notice I'm not wearing the glasses I spent a lot of money for, but they're here at my desk. So anyway, this is really funny. You guys will laugh. I went and had Jaime do a checkup, and I love technology. Jeff and I run our businesses on technology here. And the technology they had in their office was unbelievable. I can't stand having anything touch my eyes, period. Everybody says, why don't you get contacts? I won't even put eye drops in my eyes. So I'm going up to his office, and his staff is unbelievable. They have 2 separate offices, but it's the same company. And I'm going up there, and she puts me in that machine where it, you know, blows like whatever, air at your eye. And I'm like, there's no needle, right? And she can tell, you know, I'm 235 pounds, and she's watching a guy that's about to start crying because there's a needle going in his eye. Oh, no, this is not a needle. But for whatever reason, I kept blinking because there was something getting near my eye. I don't know. She did it like 10, 15 times. And afterwards, Jaime tells me, oh, by the way, they were sticking a needle in your eyeball. And so that was funny. But anyway, so I go in his office, and he has a big screen up there, and it's cool. They took pictures, and like he shows you like the cellular level of your eyeball. There's things you probably never wanted to see. And all he does is tell me all the bad things. You've got sun damage. You've got this. You're this. You're this. You're this. And then he's like, oh, and your glands are horrible. I don't know what in the world he's talking about. He's like, I need to expel your glands.
Milk.
So what would you say? Milk.
Your glands, you said,
Yeah.
right?
Wait, he said, I need to milk your glands. So I just want you guys to have this mental picture. The only time I've ever heard that is when I used to take my male dog to the vet, and they would milk his glands. So I knew kind of what was going on, but Jaime is so conservative. I looked at him, I said, do you want me to drop my pants? So he didn't know me that well. He had no idea how to respond to that. Like, I think he was speechless for like the next 20 minutes. And then when I walked out of his office, after spending like $10,000 for one pair of glasses. So never make fun of Jaime in his office. The ladies were like, are you okay? And I said, yeah, but my rear end is really sore. I'm not really sure why he had to, anyway. So I wanted to embarrass them. They're great people. They're on their 2nd or 3rd syndication. They're working on a couple right now. They're doing phenomenal. It's very exciting. They stuck through it with COVID, and you're back on the same property, right? Yeah.
Yes.
Let me tell you something. They don't let something go. They fought hard in March and said, we're going to pass, and then came back and got an even better deal. So anyway, they are awesome. But if you're in DFW, you need to see them. And if Jaime asks to milk your glands, take a deep breath, think about it before you answer him. Then we got Nick, we got Sasha.
Just to hit on that point, Merrill,
Yes.
Your team was fantastic, and it was tough, right after COVID, and but once we picked up the deal that second time, and we had an opportunity, Cindy and Greg and yourself, you guys were fantastic and phenomenal. So we appreciate you for sticking with us, and for going back and forth with the sellers. So we really appreciate that, and we got a better deal. So
No, that's all. I appreciate it. Listen, no hard feelings, but after you milked my glands, I had to move away from you. They have the cutest daughter too. Jaime's going to be in big trouble when she becomes a teenager. That's all I can say. Then we have Hutch the Marine. He's got like a helicopter behind him. I don't know what he's got. Some helicopter behind him. Haven't heard much from Hutch lately, so I'm wondering. Hutch, you want to say hello real quick?
Hello, everyone. That's a CH-53 Kilo. It's the new helicopter the Marine Corps just acquired.
I thought you were in the Army.
Can you hear me?
Yeah, I thought you were in the Army, Hutch.
Come on now. You know what the Army stands for?
Wait, my dad's in the Army. My dad was in the Army. Don't say it.
Yeah, that's an acronym, so I probably should not say it.
No. Don't. Anyway, Hutch and his partner are doing some interesting deals, and you like where are you looking at? Alabama? Where else are you looking?
So our focus right now is Huntsville, Alabama. We really do love the market. There's been significant growth up there prior to COVID, and it's been rated as the #1 city in the Southeast to live post-COVID because of the type of jobs that are available there. So we really do appreciate that market.
Are you going to move there?
Possibly not. It's too far away from the ocean.
Why don't you come to Texas? Come to Texas. We have the the ocean of Mexico. It's brown.
Exactly, right?
Yeah.
You got to know that I'm from Jamaica, beautiful beach. My wife is from Hawaii. beautiful beach. So it's a standard we have to uphold there.
I know. And then, hey, it was good hearing from you. There's also Alex is online, and Alex is kind of annoying me. So we've talked a lot, and all I see lately is he's in the wine country in San Francisco. There's supposed to be fires and stuff out there, and people are supposed to be staying in. And I see these unbelievable pictures of Alex and his family drinking wine and enjoying themselves. So Alex, I'm expecting a couple bottles of wine from Russian River Valley. That's one of my favorites. How was the river? How was the wine country?
It's still alive. Yeah, the air quality is not the greatest. This is my virtual background. Hopefully in the next week or so, things will clear up. But there's about 20 fires are still going on.
Unbelievable.
In the area. But the Russian River was great. The air quality was great. It was hot, 100 degrees, but the wine sometimes helps.
Well, you can always move your family to Texas. We have nothing to burn here, so there are no fires. It's the desert.
One of these days.
Yeah.
One of these days we will.
It's good seeing pictures of you.
We'll come visit you. We'll come visit you.
Soon. And then most of the other people were afraid to actually show their faces, and I don't blame them because it's like sitting in the front of the classroom. I'm going to call on you. Alan, I know you're there. Hey, Jeff, can you unmute Alan? I got to have an Aggie online for just a minute. Alan's my favorite Aggie. Alan, what's going on?
I'm good.
What are you working on?
Working on some back office stuff. Looking to make Q4 interesting. I'm looking forward to it.
What are you seeing out there? Are you seeing any movement in pricing in the stuff you're looking at?
That is a great question. Depends on who you ask. If you ask the brokers, there's no movement. If you ask other people, there's movement. So I guess the truth is somewhere in the middle.
So I asked what you were seeing.
Yeah, I think it's somewhere in the middle.
Yeah.
Middle.
I think we're seeing some people that are wanting to sell now, and there are a couple, we have clients, a couple had to sell, and you can tell by the pricing they had to sell. Then there's some that clearly think the value of their asset is that I think they think that there's platinum lining the bathrooms in their units. I don't know where they're coming with that, so they'll sit on those for a while. But anyway, your son doing good?
He's good, yeah. He's good. As a matter of fact, my daughter, the UNT student, took a quick trip down to Aggie Land just to, on purpose. Yeah. Can you believe it?
No, she was such a nice kid.
It was good times. I was proud.
Yeah. She have a good time down there?
She did.
Yeah. So they did or did not play this weekend?
Did not. No, I think it's 26th. Yeah, SECs.
Don't know. Man, you're not. I thought you were a big they play a
powerhouse.
We
were actually supposed to play North Texas first game, but everything got changed around.
Yeah. So. Well, hopefully they'll play a powerhouse like UTEP. That was a big challenge for Texas.
It's all going to be conference games, so it'll be a tough schedule.
Yeah. You going to go to them?
I'm going to try to go to at least one.
Okay.
Yeah.
Good for you. Well, I'm glad everything's doing well. Just keep fighting.
Yeah, man.
Hopefully we'll get a Texas A&M game one of these days.
That would be good.
Anyway, so I wanted to keep it kind of short. I went over I went past 7 o'clock. We're going to send this outline out to everybody. And I'm not kidding. Those of you that use us already know that we always answer questions. We're not the law firm where you ask questions and you pay for it. There's a lot of information here, and there's information that is not necessarily dictated by, I don't want to say investment groups, investment clubs, whatnot. This is just information out there. I will tell you, if you're part of an investment club or investment group, make sure you go through your club rules or white pages or whatever you have, and make sure that if you're trying something different, that it fits within those parameters. We know all of them. So, and we always ask you ahead of time, are you with or affiliated with a certain investment club to make sure everything works. But guys and gals, now is the opportunity to go out and do deals when you see good deals. and you can structure some very interesting deals. There are more investors getting into real estate now on the passive side than we have seen. And you guys already know I like to do wild deals. We're doing helium. Helium's actually doing really well. The project in Leander is doing really well. We have quite a few clients actually getting involved in development projects, small ones, but still development projects. And they make a lot of sense because the time frame of those being completed way past even another year of COVID. And the banks and HUD are being very aggressive on development projects. So obviously, if it's done in the right city with the right market. But anyway, everybody, please stay safe. If you have any questions whatsoever, feel free to email any of us online. And if you have a topic you want us to go over, I've got my own opinion, but if you have topics you'd like us to discuss, and no topic is a bad topic, send me an email or message me in Messenger. Be happy to discuss. I guarantee if you have a question or you're interested in something, others are. I'm not going to talk about opportunity zones. I think those are a waste right now. I've got a couple people asking to do them. They don't understand them, and it's too complicated. And I haven't seen any that actually make a lot of sense yet. But there's a lot of stuff coming. There's uncertainty with the election. I think the thing that seems most certain is interest rates look like they're going to remain the same for probably the next year or so, no matter what happens. So as long as interest rates are low, it always creates opportunity for us. Anyway, everybody have a good week, and thanks for joining.